Most traders think of an exit as simply getting out of a trade and generally for a profit. In this lesson, we're going to show you two components of an exit, which must be utilized on every trade. Now, just like a watch functions when all the parts of the watch are working together, so do your trades. All parts of the trade need to be considered before entering into any trade. Those basic elements that we need to consider are the stop, the entry, and the target. Within that, we have our two components of the exit. We have the stop, which is the predefined risk or loss we're willing to take on the trade, and we have the target, which is the predefined profit we hope to make on the trade. All decisions about a trade and its management are made prior to placing the order because that's when we are the most objective. Once the order is placed, we become biased and we naturally want the trade to work. That is why it is so critical to pre-plan our initial stop loss and our initial target before we enter into any trade. Exiting a trade for a loss is never something we want to do. But if the plan doesn't work and the trade isn't going in our favor, then we need to get out. Now above in the top left side of the screen, we can see two exit strategy examples. The first example is a short trade. This is one where we anticipate price coming back up to the supply zone and reversing direction and coming back down. We'll know that the supply zone didn't work once the price breaks above the distal line of the supply zone. Therefore, we place a stop loss as a buy stop market order, and we place it just above the distal line of the supply zone. Now recall that in a short position, we always sell to open the position and we buy to close the position. Now looking at that same example, we also see there an example of a long trade. In that example, we buy to open the position and we sell to close the position at a predetermined loss. In that case, we use a sell stop market order just below the distal line of the demand zone. Notice that in both situations, the stop loss orders are placed at market price. To exit a trade once we've hit our predetermined profit target, we'll be using limit orders. Looking at the two profit target examples, the top example is a short. Here we have a target set for the opposing demand zone. We can place a buy limit order to cover and close our short position once price falls to those levels of our profit target. In the bottom example, we have a long position. We see there a target set at the opposing supply zone. We place a sell limit order just below the proximal line of the opposing supply zone to take profit. Since all decisions about a trade's management are made prior to entering the trade, we complete our pre-planned setup using what is known as SET. And this stands for stop, entry, and target. In the top example of a short, we will be entering the trade using a sell limit order. From there, we can now define our risk by appropriately placing our buy market stop order above the distal line of the supply zone. Now the final step is to set our target at the opposing demand zone by using a buy limit order defining our potential reward. For a long position, it's just the opposite. In the second example, our entry is a buy limit order to open a long position. Our initial stop is a sell stop market order, and at our target, we will be using a sell limit order. A stop always goes just beyond or outside the distal line, and we'll take a look at exactly what that means in a practical sense. If we're going long, the stop loss goes below the demand zone. And if we're going short, the stop loss goes above the supply zone. Pretty simple. In this example of a long, we have our number one entry, the proximal entry, and then right on the proximal line of the zone is where we place our limit order. As the market pulls back into our zone, our buy limit order is there to enter us into the trade. We set the initial stop loss just below the zone, and our target is set just in front of the opposing supply zone. Now, here are some important considerations to make with our exit strategy. Number one, always make sure you have a clear pre-planned stop and price target. Trading can get pretty emotional, so make sure to set up your trade when you are the most objective. And again, that is before you enter the trade. The second consideration, look for opportunities where your target represents at least 3-to-1 reward to risk ratio. Even better, try to find one with a 5-to-1 reward to risk ratio. Now, even if you don't hit that type of price target of 5-to-1, you have a better chance of at least getting closer to your 3-to-1 reward to risk ratio. The third consideration, always exit the trade before the competitive buying and selling begins. So if we enter the trade with a buy order, we set our profit target right before our opposing supply zone where institutional sellers are waiting to enter the market. And we exit just in front of them, taking our profits and closing down our trade before the real selling begins. Now, in the event when you're selling, it's just the opposite. We set our profit target just before the opposing demand zone, where institutional buyers are waiting in the market, and we exit just in front of them before the real buying begins. Finally, we manage a trade by moving the stop market order in the direction of profitability. So let's talk about what that means. If I'm going long, I enter the trade with a buy limit order. As the trade moves in my favor, or rather as price goes up in the chart, I move my sell stop market order up just below each demand zone. So as each demand zone forms within the breakout segment of the uptrend, I'm going to place or move my sell stop market order below that newly formed demand zone. So now take a look at this setup of a short position. If you look closely, you can see the drop-based drop supply zone. Our entry would be at the proximal line, and our initial stop is just above the supply zone. Our initial obvious target will go in front of the opposing demand zone. But as we look at this chart, can you see if there are any trouble spots between our entry and our target? If you look closely, right in the middle, we have a drop-based rally formation. That means there are buyers there. As the market trades into that area, our amount of risk is going to increase. So in order to mitigate that risk within that particular location, we would basically set another target. And we would kind of refer to it as a more conservative target, which ultimately ends up becoming our first target. If the market reverses in that area, we can stop out. And in that case, we have a profitable trade, but we'll make a little less money than we would have made if it were to hit our initial obvious target. The more conservative target has a better chance of getting filled, but it's up to us as traders to determine what to do next. We can close the position entirely at target 1, or we can just reduce some of our risk by selling a portion of our position, keeping the rest of our position open in case it hits our main initial obvious target. Remember, it's important to set our targets in front of the opposing supply and demand zones, and we need to make sure that our main target is at least a 3-to-1 reward to risk ratio. If your first target has a 3-to-1 and your second target has a 5-to-1 or greater than 5-to-1, then that is even better. So now you know the two components of the exit, the stop and the target. Exiting a trade for a loss is never desirable, but it is necessary to avoid taking larger losses. Recall that a trade will end one of 5 ways: a large loss, a small loss, break even, a small gain, or a large gain. By eliminating the large loss with a stop market order, we increase the odds greatly in our favor and can still be profitable even if we lose more trades than we actually win. Remember, large losses can not only destroy your trading account, they can ruin your trading psychology. We all want to exit for a profit. That's why we're trading. But as we progress, stops and targets should be integrated into every trade that you make, regardless of the desired outcome. Before you move on, review where to place your pre-planned stop and targets. Recall that a stop loss will always go above the distal line of the supply zone, and it will always go below the distal line of a demand zone. A profit target, if you're selling short, will always go above the demand zone, and your profit target when buying long will always go below the supply zone. Also, review any previous charts that you've drawn out and identify where you would consider placing your entry, your target, and your stop loss. Hope to see you in the next video.